If you are an employee covered by either a 401k or 403b plan and you've turned age 50, you are now eligible for what's called a catch-up contribution, which allows you to contribute more than the regular annual limit. But the issue here is the IRS recently made these catch-up rules way more complex. It used to just be if you're over age 50, this is the extra amount you could contribute. But now there's a new special age 60 to 63 catch-up contribution. And then starting in 2026, there's going to be a new mandatory Roth catch-up for high-income earners in these 401k and 403b plans. I'm going to be addressing those topics today, as well as other frequently asked questions on catch-up contributions. I'm Michael Ruger. I'm the managing partner of Greenbush Financial Group. We handle hundreds of millions of dollars in 401k assets at our firm. So we get these questions all the time from plan participants. But some of the main topics we're going to be covering today are the 2025 catch-up contribution limits for 401k, 403b plans. There is the new 401k age 60 to 63 catch-up contribution, knowing the difference between a Roth catch-up and a pre-tax catch-up contribution, as well as the new mandatory Roth catch-up contributions that are coming from high income earners starting in 2026, and some of the tax strategies that we advise individuals to use when implementing these catch-up contributions. For 2025, here are the 401k and 403b contribution limits, which include these catch-up amounts. So the regular employee deferral limit for 2025 is $23,500. The age 50 to 59 catch-up contribution is $7,500. The age 60 to 63 catch-up contribution, which is new, is $11,250. And then age 64 plus, it reverts back to that $7,500 catch-up contribution amount. We'll start off by addressing the brand new age 60 to 63 catch-up contribution amount. This was part of Secure Act 2.0 that passed a few years ago, but there were so many changes that were made to 401k plans that they actually had to phase them in over the course of a number of years. So for 2025, this new age 60 to 63 catch-up contribution showed up, where previously it was just if you were 50 or older, you got the special catch-up, which this year would have been $7,500 over the regular annual employee deferral limit. But now the way it works is this 60 to 63 age group, they can put in 150% of the regular catch-up amount. So since 2025, it was $7,500. The new 60 to 63 catch-up amount is $11,250. For example, if you're age 59 in 2025, you get to contribute the regular employee deferral amount of $23,500. And in addition to that, you get the $7,500 catch-up to get you up to $31,000 in total. But if you're age 60 in 2025, you get the regular $23,500 deferrals, but then you get $11,250 for your catch-up contribution, allowing you to contribute a total of $34,750. If you decide to make a catch-up contribution to either a 401k or 403b plan, there could be another decision you have to make, which is whether you want to make those catch-up contributions in pre-tax money or in Roth money. So remember, pre-tax money, you get the tax deduction now, it goes into the plan, it accumulates, and you pay tax on all of it when you take it out of retirement. And then Roth catch-up, similar to Roth deferrals, you pay tax on it now, but all the accumulation, if you take it out after 59 and a half, you don't pay any tax on any of that source. Pre-tax catch-up are by far the most popular because the way it works is by the time someone's 50, usually they're getting in their peak income earning years right before they get to retirement, and they're usually in their top tax brackets. So those pre-tax catch-up allow them to take more money off the table now in their peak income earning years, and then push that money into retirement and take that out when they're hopefully in a lower tax bracket. However, there are three scenarios where sometimes we'll advise clients to make their catch-up contribution in Roth dollars and actually pay tax on that money now. And one of those scenarios are if they don't think their tax bracket is going to be any lower in retirement, or in some unique situations it could be higher, you might as well just pay the tax on those contributions now and let the accumulation be tax-free down the road. Situation two where Roth catch-up contributions can make sense is if someone has already amassed a substantial balance of pre-tax retirement account balances, whether they're in traditional IRAs, 401ks, 403bs, because the issue is if someone has already accumulated $3 or $4 million in a pre-tax retirement account, at some point when they retire, they're going to hit what's called an RMD age, or required minimum distribution, which at, let's say, 73 or 75, depending on your date of birth, the IRS forces you to start taking money out of these pre-tax retirement accounts. Well, what if your first required minimum distribution is $100,000 and you have pension and Social Security in addition to that? That could then bump those retirement dollars up into a higher bracket, where if we look at someone and says, you already have lots and lots of pre-tax, maybe we should start contributing some of that money via the catch-up contribution in the Roth source. The third scenario where Roth catch-up contributions can make sense is more of a tax diversification strategy. So if individuals think tax rates are going to rise at some point in the future when they're taking this money out, they might say, hey, I've got some pre-tax money going in, but I might as well pay some tax on some of this money now via maybe a Roth catch-up. So some of this money in my account, I've already paid tax on, and could withdraw tax-free if tax rates happen to be higher in the future. The next level of complexity in this catch-up contribution world is what's going to start happening in 2026. So in 2026, again, part of the Secure Act 2.0 phase-in, there's another iteration of these catch-up contributions, which for high income earners, they may no longer have the option of contributing their catch-up contributions in pre-tax. They may be forced to do them all Roth. The way this is going to work is if you have $145,000 in W-2 wages with your same employer in the previous calendar year. So you're going to look back at the previous year with that same employer and say, did you make more than $145,000 in W-2 wages? If the answer is yes, then if you are eligible to make a catch-up contribution in that current year, you are no longer able to make that catch-up contribution in pre-tax dollars. They're actually going to force you to make it in Roth dollars. But again, this is not something that is going to place in 2025. This is something that's going to go in place in 2026. This could very much be a tax disadvantage for these high income earners going into the 2026 tax year, because they may have been previously able to do, let's say, $7,500 extra in pre-tax in 2025, where as soon as they flip into 2026, they're no longer able to do that $7,500 in pre-tax, because if they made more than $145,000 in W-2 wages in the previous year, they can make that $7,500 contribution and catch up, but it'll have to go to the Roth source, which is after-tax dollars. For employees that are covered by these retirement plans that are age 50 or older, these catch-up contributions have so many benefits, even beyond just the tax strategy stuff. When we talk about longevity of clients, if we have a client that's retiring at 60 and their life expectancy is 90, they have 30 years that they need their assets to sustain themselves for, yet their expenses are going up every single year for inflation. So by being able to contribute more to their retirement accounts in the last 5 or 10 years of their working years can benefit huge over the long run. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.